is Caleb. And well, hey, look, I'm official now. Got me a nice little wired mic. But one of the things that when it comes to home buying that gets people just understandably anxious is becoming what would be considered mortgage ready. Now, what that includes, well, it depends on who you ask when it comes to the internet. In fact, depending on who you ask, you might think it's impossible because so many people are saying you need to make six figures in order to afford even the cheapest homes, or you need this, or you need that. And understandably, people just get so like freaked out over it that they're like, why even try? And that's understandable. But one of my goals as a real estate agent is to prove to people, especially first time home buyers, that getting ready to get into a home is not the impossible task that many might make it seem to be. So, with that in mind, here are three actionable steps that, if you do them, and you can do them actually start today, that it will get you ready for when the time presents itself to get into a home. So, let's get started and let's cover the first one. So, the first step of this three steps that you can start doing right now is understanding your credit score. Now, I know a lot of people have very, depending on who you ask, anywhere from optimistic to very cynical views of the credit scores. But to put in the simplest terms, a credit score is basically a report card that tells lenders how well you can pay back your debt. So that's why as you pay debt off, your score will go up as long as you still have some. And I even had a client once that they had no credit score because they managed to pay everything off. I know it's a little weird. You might wonder why on earth, but it's just lenders need something because think about it from their perspective. They are giving you hundreds of thousands of dollars depending on the loan amount. So they need all the proof they can get that you are good for the money. Now, the other thing on top of the credit score, what helps that a ton besides just debt is credit card utilization. Now, normally you need to keep it, of course, emergencies happen. And it's that you have to max out a credit card because, hospital, family emergency, that's just life. But unless that's going on, what you should do is keep your credit card utilization under 30%. I mean, ideally, if you can, work on the credit card, but make sure to pay it, maybe pay it off completely before the interest would hit, because then it can help improve your score while you don't actually have anything build up from interest. So, yeah. And if all this is confusing and you have no idea what your credit score is, there are programs out there that will help pull up a free credit report. Now, it may not be really thorough because it's not like a full credit report that usually would cost money, but things like Credit Karma and whatnot can at least help give you an idea of if there's any like red flags you need to deal with, or just help point out a good starting point of where to go, whether that's with debts, whether that's maybe you're maxing out credit cards, maybe you need to get them, really tear down how many you have, if not get rid of all of them, all you Dave Ramsey fans out there. But no matter what, it's just, I'm going on because this is the most important step. It's like the first thing a lender is going to look at is, well, your credit score, because based on that number, it's going to kind of tell them everything else we're about to cover. So get that in line and let's get to number two. The second thing you need to work on is the debt to income ratio, or DTI for short. Now, obviously, the name kind of tells you what it is. It's your debt to your income. But to put it in another way, it tells lenders your DTI is how much of your income is claimed by debt. And if it's over 50%, unless you got something extraneous that can help you out and look good, most lenders are going to kind of be a little uneasy about that because it tells them if most of your income is already claimed by various debts, then you don't have anywhere else to put a mortgage. And I know you might think, well, part of that would include my rent. And yes and no. It gets a little more complicated than that. So I'm not a lender. I won't get into the details. But just know, how do I improve that? Well, you pay off your smaller debts, because the smaller debts, like let's say maybe maybe furniture, 'cause you went to an outlet store or something, or maybe you put a few things on layaway, whatever it is, no judgments here. But as you get those small debts paid off, it frees up your income and tells lenders, hey, here's where you would actually have money to pay for this mortgage, uh, especially depending on what you would qualify for. Now, the other part, that's the debt part of things. The income part of things is lenders need to see stability. The magic number is 2 years. And That's just because it shows that the money you are making isn't going to go anywhere. It's not feast or famine. And that is proven through like W-2s and pay stubs, but we'll get to that in a minute. Just know that when it comes to income, it just needs to be steady. And also, as I have learned from lenders I've spoken with, if you are about to change jobs, ideally wait until you're already in the house. But of course, life still happens, and you might have to change jobs before you can really go house hunting because maybe life just forces you to. If that's the case, understand this. As long as the next job you go to and you're able to prove it with paperwork, it pays the same or more, then you're good. A lender will just see that as a positive. Where it's a problem is if the next job you're going to pays less. And then obviously, when it comes to all of these, you might be wondering, what if you are a 1099, aka someone like a real estate agent, where you don't have a salary or a steady paycheck? Well, there are things as well. There are things there as well, but just know I'm not a lender, so I'm not going to get into the details of that. I just want to talk in broad terms of get your debt in order. So that way it shows lenders you have the room for a mortgage. And two, make sure your income is steady and that you can prove it with paperwork, as we're about to cover in the third step. And the third thing is basically getting your paperwork together. And I alluded to in the last step of you need to prove your income is steady. And we talk about the magic of 2 years. Obviously, the quickest way to prove that is W-2s. And the other thing as well is once you get closer to applying to see what you can afford, make sure to have the last 2 months of your pay stubs and last 2 months of your bank statements. Now, if you want to have more than that, believe me, lenders do not mind if you have like more paperwork than needed. They'd rather have too much information when it comes like, and not too much is in like TMI, but too much is in like they'd rather have so much information they have to tell you like, hey, this doesn't matter, rather than not enough to where they can't really tell you anything good or bad. Now, of course, you can save all this paperwork digitally or physically. I personally would say do it digitally because more and more applications and stuff are done online. So just being able to having it on a thumb drive or Google Drive, Dropbox, whatever you use, and just ease of access to where you can upload it wherever you go. That's good, and it makes this life much easier for everybody. And the reason why I talk about these particular papers is these are going to be asked by any lender you talk to. There are other lenders that might require other things just depending on what you're trying to apply for. But W-2s, bank statements, and pay stubs, you can never go wrong having those. And I guarantee every lender is going to ask for those. So just have that ready. So as you can see through these three steps, the mortgage ready process is not near as impossible as people like to make it seem to be. It's as simple as understand your credit score, work on your DTI, whether that means clearing out debt or at the very least having steady income, maybe both, and get your paperwork together. Now, these might take time depending on what your financial situation is, but it's not impossible. Definitely not compared to how the cynics out there say. Now, I know this can be a lot, especially talking about terms that if you're not in the real estate world, you don't have to deal with in day to day life. That's where guys like me come in. I would love to be able to help you out. I actually do host multiple seminars a month, both in person and virtually. And you can book a consultation with me in case you just want to talk over Google Chat. In fact, all the links to everything I'm talking about is going to be in my link tree, and that will be in the description below. So if you are interested, whether you are brand new to the process or if you've done it before, but let's say maybe it's been a while, and of course, the real estate market shifts all the time. So I would love to be able to help you. And please click on the link below to all my socials and everything. So I'd love to be able to help you out. So this is Caleb, and I'll see you in the next one.